Certainly a renewed focus on the health of the consumer after some better than expected data lately, so that is all even more relevant now. It takes us to our talk of the tape. Whether the bullish momentum is back following that scare a couple weeks back. Let's ask our panel that question. Chris Hyzy is CIO, Maryland Bank of America Private Bank. Lauren Goodwin is Chief Market Strategist with New York Life. And Malcolm Ethridge is Executive Vice President of CIC Wealth and a CNBC contributor. Good to have everybody with us. Lauren, I'll come to you first. Evercore ISI today says the trajectory for equities skews higher. Goldman's trading desk today says the pain trade is higher. I want everybody's opinion, and I want yours first.
I expect that the market can move higher as long as the economic data stays in line. That means as long as new unemployment claims aren't rising above what I see as a critical level at 260, and as long as earnings remain robust. The real challenge for investors is that though that essentially looks like a melt up higher is certainly possible, the market is likely to be incredibly reactive to the economic data. Now, why is that the case more now relative to any point in the last couple of the years? It's because now good news is good news and bad news in the economy is bad news for the markets. The Fed's focus on inflation has transitioned to one on the labor market and growth. And so I do expect that though the market can continue moving higher, is going to be a very bumpy road ahead for the next few months.
Malcolm, our question right there on the screen, is the bullish momentum back? Yes or no?
Yes, Scott, I'm a bit in agreement in the sense that any news that we get is going to be a pretty big push in both directions. I think that investors are pretty split right now on whether we think that interest rate cuts is a good thing or a bad thing. And so I definitely think that we're going to get, I'm surprised to see the VIX down so low today, because I definitely think that we're going to get movements sort of on a razor's edge of any economic data that we get Wednesday and Friday, obviously.
So, Chris, how do you address this? Is the pain trade higher? Are we skewing more positive? And it's remarkable the kind of conversation here that we're having, given what happened 2 weeks ago. But we've moved fast and far away from that.
It's amazing what 2 weeks will do, but it's amazing what last week will do. I would say, to directly answer your question, Scott, it's going to be very, very difficult to stop this market from going higher. And the reason is, data is being set up to be lukewarm. Exactly what the Federal Reserve is looking for, exactly what investors are looking for. We might get a little miss here or there, but not material misses. There's a lot of distortions in the data over the last couple of months, but when you average that together, and now on a go-forward basis, given what we saw in some of the recent reports, this data is lining up to be lukewarm. And Lauren's right. Good news is good news, bad news is bad news. But you blend those two together, and you get lukewarm data overall, and this market wants to go higher.
You could say Goldilocks if you wanted to, Chris. That's what I think of when you say lukewarm. Just right.
Yeah, I like to use another term, which is basically balance. The balance that we don't have is usually the unknowns that we know. It's geopolitical risk. We can't fix that. But what we do know is what the Fed is going to tell us. We do know where they're headed. They've told us that before. And the Fed funds futures market will shake us out here or there. And we'll, Volmageddon was a way to clean up the excess. And now we're starting to get a little bit better base going forward. Now, it doesn't mean that performance is going to be as good as it was. It simply means we have a healthier base to build from.